Assalamu alaikum wa rahmatullahi wa barakatuh. This is a continuation of sales and distribution, and now we're looking at the steps for uh, creating a sales order. So, as you see from the figure, what triggers a sales order, creation of a sales order, is that a customer would send you a purchase order. So, you get a purchase order from the customer, and that triggers you, leads you to creation of a sales order. On the sales order, you will have organizational data, and in specifically, you are entering your company code, you're entering your sales organization. You have master data because the customer, of course, is one of the master data. The material that they are ordering is a master data. And user input like the quantity that they want, when they want the delivery, and so on. So creating the sales order would also, as we said, result in a check of the credit. You will not right away submit a sales order unless you perform a credit check. And that credit check will involve finding out what's the current balance for the customer, how many orders are open currently, how many deliveries are about to be delivered. You want to make sure you are not extending or you are not giving that customer products above the credit limit, and also to make sure that they are paying their balance on time. The outcome is the creation, of course, of a sales order. You have to update. If you have a contract with the customer, and the contract says that every month, for example, you are to ship a specific quantity, then when you create the sales order, you have to update the contract that currently in process as a particular sales order that decrease the amount of the total quantity listed in the contract. You have to do an availability check on whether you will be able to deliver on time, and if you can transfer material from one plant to another in order to fulfill that order, you would go ahead and do that. Part of the processing of the sales order, of course, is, again, as we said, we are entering customer and material data. These are the master data. You have to enter delivery date and make sure you can deliver by that date. And you have to enter quantity and make sure that you have available in stock the quantity, or that you can transfer them from another plant. Pricing conditions either are copied from a quotation or are now added to the sales order based maybe on a contract or based on specific standards. So if, for example, the quantity ordered is higher than a certain threshold, then you would give a discount. If the customer is ordering a specific material, you may give a discount. Now you will enter the shipping information, and that would include the shipping address, would include the FOB, the terms, who will pay for shipping, and so on. And then billing information, again, billing address, who is the billing entity that is responsible for getting the bill. So again, information are coming from the customer data, from the material master, from a contract that you may have with the customer. This figure will make it easy for you to find out what information you need. So as we said, we need organizational data, and that will include which company you are, which is the company code. We talked about the sales area being three things together. That's the sales organization, the distribution channel, and the division. So all three together will make the sales area, along with the delivery plant. Which plant will deliver the material or will ship the material to the customer. We have customer information, as we said. We have contact information, shipping data, which is the shipping address, billing data, again, billing address, who's responsible for getting the billing, We have the material master. We have user input as to material number, the quantity, dates, when they want to get the material. As a result of that same order, we will create a customer material information record, or that will be updated. A new combination of material and customer record will be created. Contract may or may not exist. If it exists, then it will tell us what's the quantity, what's the price, because that's based on a contract that we have with the customer. We talked before about sources of creating a quotation. Now we're looking at source for creating a sales order. So I may have two quotations that result in one sales order. So, which of course the two quotations will have to come from the same vendor, because you cannot send one sales order to two vendors. So you have two quotations from the same vendor for two different material, and you're using both quotations in order to create one sales order. That sales order most probably will have two material, at least two material, a material from quotation 1 and a material from quotation 2. Or I may have one quotation that serves as the source for two sales orders. How is that? That's when you have two sales orders that are apart in terms of time. So you're using the same quotation to order this month and again next month, or this week and again next week. So because the quotation is valid for a certain period of time, it may be 60 days. So for the 60 days, if you are ordering the same material, then you use the same quotation. You don't need to create another quotation. You can use the same quotation to generate two or more sales orders. Now, like you have seen when you created the order, there is a part that is the header, and you also have we have a header that's by itself, and we have the body of the standard order, which is the item overview. So in the header, it has only who is the customer that is ordering, the date, and where you are going to ship. But the actual body lists the particular quantities and material that are ordered. So as you can see here, we have two items. We have t-shirts and we have bikes, and the quantities are 100 and 40, to be split in two deliveries, one on May 10th and one on June 10th. So the material, of course, we said that while we are entering the sales order, we'll have to check inventory. You may not have in stock the material required. So what do? Either you are going to start production, or you have them in stock and you are going to do an outbound delivery, or you have them in another plant, so you are moving from one plant to the other, or you have to buy them all together from outside. So you buy them from an external vendor and you resell them to the customer. When we start shipping, let's say we already have the material in stock and we are ready to ship. We talked about shipping taking 3 steps. The first step is creating the outbound delivery, which give permission to the warehouse to release the products, the material, and the quantity order. They have to be picked up The second step is picking up these materials from the warehouse, sending them to the packing area. When they are already packed, ready to be shipped, then we post goods issue. So first thing is creating the outbound delivery. Second is picking. Picking and packing is one step in SAP. And the third is post goods issue, which is shipping. It is when you post goods issue that an accounting effect on is reflected on accounting, because now, as we said, ownership is transferred from the vendor to the customer. So it's no longer belongs to the vendor. It actually passed ownership to the customer. I may have multiple deliveries for one order, or the opposite, multiple orders and one delivery. So a customer had like 3 orders and we are going to ship only once. Of course, it has to be the same customer, the same shipping point, which means that you are shipping from just one place, and same delivery date, same ship to address. Otherwise, it will not be the same delivery. It cannot be the same delivery. If you are shipping to 2 different addresses, that's 2 different deliveries. If you are shipping to 2 different customers, again. If you are shipping from 2 different shipping points, so one by air, one by boat, then again, these are 2 different shipping points. So it has to be same customer. I have to be shipping from the same point. It has to be the same delivery date. It has to be the same ship to address. Any combination in any of these would result in 2 deliveries actually. So as you can see, I can have 2 orders, 1 delivery, or I can have 1 sales order and 2 deliveries. Why do we break the delivery? Either it is a request of the customer himself, or it is because of a back order. We could not deliver all quantity or all material in delivery 1, so we have a back order and have to deliver again the rest. As a result of the post goods issue, we have several accounts that are updated. Of course, inventory will have to reflect now that ownership has gone to the customer. The cost of goods sold account will have to be updated to show goods that have been sold. These are the financial documents. On the control side, the control, remember, is focused on revenues and expenses. So you have to report the revenue, the profitability from the cost of goods sold. So that will also result in impact on the profitability analysis. Now that you have again post goods issue, you are able to bill the customer. So the billing due list is updated. And the sales order is also updated, the status of the sales order. So if you run a document flow, you should be able to see that the goods have been picked, that they have been shipped. So summary of what we have said. Inventory will have to reflect on the post of goods issue, because now, even though they have left the warehouse, so there is a decrease in inventory. Cost of goods sold will also be updated to show the goods that have been sold. So that's the accounting. As a result, you have a financial document that shows the cost of goods sold and decrease in inventory. You also have a control document that shows profitability, reflection of the goods that have been sold on the profitability analysis. And again, inventory, because of the selling, the material document is created to show that there is a decrease in inventory. Your billing due list, as we said, now that you can invoice the customer. Um, the bill should show the material that have been sent, the sales document or the status of the sales order is updated, and of course the material master will have to be updated in order to show a decrease in the quantity of the particular material that you sold. So remember that inventory is an asset. So a decrease in inventory would result in credit of inventory. So you're crediting it with 42,000 for for the finished goods for the bicycles, and 1,500 for the trading goods. This is for the T-shirt. Your cost of goods sold is a debit, um, and that should reflect the 43,500. So when we ship, these are the two accounts that are affected: inventory, cost of goods sold. Now when we run billing, then other GL accounts also got affected. Remember, when you bill, you are invoicing the customer, so of course the customer account will be affected. Now we have in SAP you have two accounts. You have a customer account that is an account that is tied to that particular customer, and as soon as you debit or credit that customer account, then the accounts receivable in the general ledger also gets updated. So we have customer account in the sub ledger, and you have the accounts receivable in the general ledger. They are both affected at the same time. So you debit the customer account, and automatically the accounts receivable is debited, and vice versa. If you credit, then again accounts receivable will be credited. And now you have realized that revenue. So in the previous step, when we were doing the post goods issue, only inventory and cost of goods sold got affected. But now that you have actually invoiced the customer, revenue account got is credited. And again, that reflect on the profitability analysis in control. Remember, control, as we said, is not about recording the transaction. It's about looking at the expenses and the profits per department, per division, and so on. And again, the sales order, you will see that the sales, when you run billing, then you get an accounting status shows now in the status of the sales order. So as you can see now from the T accounts, in billing, we have the customer account debited along with the accounts receivable, account in general ledger. The customer account is in sub-ledger. Every time a particular customer account is debited or credited, it should reflect automatically in the accounts receivable account. We also have a credit for revenue because now the company have actually realized that revenue. Our last step in sales and distribution is actually receiving the payment. That would result in, as soon as you post the incoming payment, then the customer account is credited this time, accounts receivable is credited, and your cash or bank account is debited for the amount of payment that you have received. So the GL accounts that are affected are customer account, the accounts receivable, and the cash or the bank account. So as you can see, when we bill, we debited the customer account for 86,700. We received the payment, so we would credit the customer account. That would automatically credit accounts receivable, and that money that we have received, we should have deposited it into a bank, so we would debit the bank account. That's of course a current asset, so anytime you increase the current asset, you would debit that account. One last thing that we mentioned early on is that credit management is done when you are processing a sales, when you're creating a sales order. You want to make sure that the customer is not extending, or you are not extending beyond credit beyond the limit to a particular customer. So orders are coming all the time. When you create a new order, you need to check first, how much credit have you already extended to that customer? How many deliveries do they have currently going on that they have not paid for? How many post goods issue? What is the amount? What is the value of the current order? So you have several open orders that have not been paid yet, or several deliveries. You have invoices. You have a very big order now. You have to make a decision: should I go ahead or should I block that order? So the outcome can be you need to really warn the customer that they need to pay part of their balance, or if it is beyond the tolerance limit and beyond the limit, then you need to terminate it, or you may block it and say we'll keep the order live, but you have to pay within that period before we actually proceed with the post goods issue. One very good question that Noof was asking the group on production is integration with other processes. And as you can see, sales and distribution is tied to so many other modules. Of course, I mean, like every single module will see financial accounting, because every single module will handle money some way. So with sales, you are receiving payment, you are invoicing the customer, you are receiving payment. So, and we have seen that as soon as we post goods issue, inventory will be affected, cost of goods sold will be affected. Later on with billing, accounts receivable is affected, revenue is affected, and then we credit the customer account as soon as we get payment. So financial accounting is definitely affected, but also managerial accounting because of the revenue. So when we realize revenue, that should reflect on the profitability analysis. Production is affected because if I do not have enough items in stock, I have to start production. I may need to buy raw materials, so procurement, again, an order for a specific item that I produce may result in procurement, purchasing raw material. Inventory and warehouse management are affected or are integrated because now we have shipping, we have to release goods out of the warehouse, we need to pack them, we need to ship. So that will have to be handled with inventory management. When we are running production, as the first group was saying, before you run production, you have to actually do material planning. So that's another one. I may have a project system that is tied also to fulfillment, because projects, for example, may be handling a new production or a new service or a new material. So that project is later tied to fulfillment, selling whatever the output of the project to the customer. with this, we will stop sales. So we have covered sales from the very beginning, talked about the different organizational data that are involved. We talked about the material master, we talked about the customer master, we talked about the processes that are involved, what documents are being created throughout the process, and what information do we need, and what are the different modules that are integrated with Fulfil. So thank you all for listening, and I hope you all listen to all four um, videos before you take the quiz on sales and distribution.